Hey guys, Young here. So today I'll be doing this quick recording that's requested by my girlfriend because she's in the civil engineering industry, right? And she's always been, seeing this particular brand, which is what I'm showing on the screen right now. This particular brand everywhere in almost every construction site. Alright, so the company is Caterpillar. Alright, Caterpillar sounds like the worm caterpillar, but in fact, it's actually a construction machinery and equipment firm that actually does that manufactures this kind of machineries, and then they sell these machineries. It can be for the drilling, can be for mining, can be for farming, can be for constructions, can be for they do a lot of different type of machineries. Now, the current Caterpillar's current price is $139. We can see that. Let me just, where's my Caterpillar picture? Yeah, so this is basically how it looks like. I'm pretty sure you guys have seen it before in Singapore along those construction sites, right? So all these are what Caterpillar do. They manufactures all these kind of machineries and sell it to other countries and all. So Caterpillar is also one of the Dow Jones 30 companies, right? They are included in Dow Jones 30. And if you guys do not know, Dow Jones 30 is one of the biggest index in the world. It's comprised of these 330 companies, right? Yep. So you can see that Caterpillar is Caterpillar is over here, right? It's one of the Dow 30 companies, so it's actually quite a good company, fundamentally strong company to be included into this list. As you can see, this list includes like companies like American Express, Apple, Boeing, Chevron's, Coca-Cola, Disney. All these are companies that are very, very reputable and has been there for over a huge period of time. Okay, so now let's quickly go into Caterpillar's financials. Now we can see that Caterpillar over the years has been increasing, right? Their financials has been increasing, their revenue has been increasing. However, we start to see that their revenue increment has been slowing down over a few years. This could be perhaps the company is reaching to a maturity level. As we all know that companies have 4 phases. One is the innovation, after that follow on all the way to maturity. So after maturity we decline, but hopefully they will not decline, they're still at maturity level. Their gross margin has been increasing. That's a very, very good news considering that it's a matured company. Over the years, we also seen that net income has been increasing, except for 2016, we have seen that there's a negative one. Likewise, it reflects similarly on the earnings per share. It shows negative. But the reason why it's negative is because in 2016, they actually have higher and larger than expected restructuring costs. That includes things like the mark-to-market losses, the pension and OPEB plans, etc., etc. So all these are things that made the company lose money for that year. But other than that, everything seems quite good. They're giving out a healthy dividend of $3.28 per share. It's around 51% payout ratio. Alright, so it's also quite good. Over the years, we have also seen that Caterpillar has been buying back their shares over the past 10 years. So this suggests that the company is performing well. They feel that the current share price is cheap, and that's the reason why they are buying back their shares. So following that, we go down all the way to the return of equity. We've seen that return of equity is it's rather, I would say it's not very, very consistent, right? Because you see it fluctuates to 40 something, then fluctuates down to 19. But overall, at the latest few quarters, we can see that it's still currently above 15%. So that's good news. For return asset wise, it's 7.91. As the company focus on manufacturing assets, right? It's manufacturing machineries. So the machineries they need to manufacture these machineries are called the assets. And then currently the assets are performing well. Hence, there's a very, very strong return of assets of 7.91. So that's good. So next we look at the financial health. Financial health debt to equity ratio is considerably high because end of the day, they require a lot of money to buy these machineries, to build the machineries. Same goes for Boeing. If you go to check out Boeing's debt to equity ratio, it's also considerably high because they have to borrow a huge, substantial amount of money to build the factories, build the plants, buy the machines, to build machines for other companies so that they can operate. Alright, so this is how it works, and that's the reason why they have very, very high debt to equity ratio. Okay, so now next let us quickly go on to the earnings. So for the earnings wise, we can see that over the years, Caterpillar has been beating EPS consistently, but we notice that over the years, Caterpillar has not been really beating the revenue. There's always missing revenues by last few years was quite terrible. The previous few years, 2014 or the 2014 to 2015 period was quite terrible. They missed revenues by hundreds and millions of dollars. Currently, they are missing revenues by almost around less than $100 million, and they're actually improving in terms of performance. So that's quite good, I would say. When we take a look at it, the recent earnings, I think it was just last Wednesday, Caterpillar actually announced earnings. They have a beat on earnings by 0.08 cents, beat on revenue, and then they raised their full year, means 2019. They project that their EPS, they'll be doing better compared to previous year. So the Caterpillar hikes their full year EPS outlook from this $12. This is the initial one. To this is their initial outlook, right? This is their initial $11.75 to $12.75. They raise it all the way up to $13.06. This suggests that the company is very, very confident in the months to come, and how they're going to make this money, and how they're going to retain all these profits. All right. So he also says that the 5% year-on-year revenue increment is primarily due to higher sales volume. So this means that there is demand for the company's machinery. So that's also another positive thing that we're looking out for. Now when we take a look at the calculator, now this calculator is the calculator that I created, right? So it's not shared yet, but I'm looking to share it sometime soon in the future. Think how we're going to share about is still up to discussion, right? So anyway, let's putting that aside first. When we take a look at Caterpillar, the market cap is $80 billion. Okay, so mean to say the whole company is worth $80 billion with 104,000 employees under Caterpillar. So they give out a dividend yield of 2.74%, which is, I think, is quite good. The current P ratio is 13.54. We are looking for company's P ratio below 12. Now, if you're a bit less lenient, it can be below 15. So it's really up to how you guys are actually determining what is undervalued for you guys. For PEG ratio is 0.71. We're looking for companies that is under 1. So this passed the criteria of PEG. For forward PE, it's 10.74, suggesting an undervalued company here. For price to book is 5.74. You also notice that it is down 13.97 from its 52 weeks high, and is up for 24.07 from its 52 weeks low. So this is something that you can look at. So currently it's kind of in the middle, I would say in the middle. Then when we look at the year-to-date performance, we have noticed that Caterpillar is up 9.41% in the market from January 1st, 2019 all the way till now. They're up 9.41%. So if you invested in 1st January, right, you actually made 9.41% already. Okay, so now next, let's look at the intangible assets. For Caterpillar, I'll say there's a brand. But I would not say that there's a network effect, because if you think of a network effect, you usually have to compare Facebook, how number of users in Facebook affect the network effect. So next, also monopoly scale. Yes, I feel that they have a monopoly scale because they are one of the biggest in the industry making all these equipments. There's cost advantage also. There's a switching cost, because end of the day, if you're a construction company is doing Caterpillar stuff, the employees will be trained by Caterpillar's employees to make sure they know how to use the machineries. And once a company buy a machinery, it costs millions of dollars, right? They can't possibly quickly switch away these machineries. So there's a huge switching cost on it. And I would say maybe there's not much pricing power because there's other companies that are doing it. So in that sense, I would say I'll give it a no just to be safe. Alright. So after which we look at the presence of technological risk. For now, I would say it's a no technological risk, because end of the day, it's still hard. I don't know, man. Okay, maybe there is, because I can't seem to explain why there's no, right? So let's be conservative. Let's put there's technological risk. There's no inflation risk, I would say, because end of the day, it's not consumers buying the machineries, it's business buying the machineries, and that's why I say there's no inflation risk. For political legal risk, yes, I would say there is, because one of their largest customers are China and US are currently having a full-on trade war. So the good thing is that there's potential trade talks happening on 30th of April, so that's very, very good news. However, as much as they say that it's all going very, very positively, right? We cannot assume that the coast is clear until they announce that they have signed the agreement. So for that, I'll still give you a presence of political legal risk. For specific people risk, to be honest, I don't know who the CEO, I don't care who the COO, I don't care who is the CFO, nothing's important, and that's why I say for you that there's no specific people risk. Then when I scroll down, you can see that I have this calculator has done all the searching up and all the calculation for me. We can see there's positive revenue, positive net income. We notice that in this calculator, like we seen over here at this Morningstar page here, we can see that gross margin is below 40%, and this calculator immediately picked it up below 40%. And then we also notice that debt to equity is under 0.5. Quick ratio is poor, long-term debt to equity ratio is poor. So all these things are easily identified in this calculator already, hence giving us a confidence rating of 6.5 upon 10. So that's also because we are being very, very conservative in our business analysis and macro and micro analysis. So with that, we have a growth price of $157.35. Now the current share price is only $139.03. So this suggests that company is currently undervalued. Now when we take a look at the analyst action, we can see that currently the analysts are not very, very keen in buying the shares because they are recommending a sell to accumulate. Yeah, some analysts are recommending not very keen. Some is actually very, very keen. Sell to accumulate is a good thing. Buy to sell it's a bad thing. So we can see that they are kind of unsure where they are going, which direction they are going. But that's alright. Let's take a look at the stock chart itself. When we take a look at the stock chart, this is the current year stock chart. So with this, let's quickly draw a trend line to it to see how the market has been performing for Caterpillar. We can obviously see that there's uptrend over here, right? Because we see higher lows, and that we didn't see a higher high here, but we can see higher lows, markets performing well. Hence we draw this trend line every time hit here, bounce back up, hit here, bounce back up, here, bounce back up. Now as I mentioned, we did not see a higher trend line, right? So let's draw a horizontal line, because we can see that every time we hit here, bounce back down, hit here, bounce back down, hit here, bounce back down. So let's draw a horizontal trend line all the way here. We can see it's a best fit line, basically it's a best fit line. So we can see that this is the resistance line here, whereas the support line is all constantly moving higher, suggesting stock price going higher. Now we notice that, not really we, but I noticed that this pattern is very, very similar to this thing called the ascending triangle pattern. The ascending triangle pattern. So for this ascending triangle pattern, it looks something like this, suggesting a stock price with a bullish movement, a stock price will go higher. It requires a few things. First and foremost, it must have a horizontal trend line. Secondly, it's a higher moving trend line. And third is a decrease in volume. Now we take a look at Caterpillar's chart. We bring it up. I have to bring it very, very high up because my face is blocking it right now. We can see that since this triangle here, right, this line here, the volume has been decreasing. You can see from this black line, the volume has been decreasing. Alright, so it fulfills the requirement of an ascending triangle, and that's why I'm actually looking at this stock right now. But do also keep in mind that all this full disclaimer, I have no positions in it, and then if you're really uncomfortable in making a position in it, please do not make a position in it, because end of the day it's really up to one's risk tolerance, and you still have to do your own due diligence before buying or selling any specific equities. Alright, so I hope you enjoyed today's this quick session, this quick analysis on Caterpillar, and hope to see you next time. Bye bye.